Welcome back to More Wealth Retirement Talk. I'm Dave Moore.
And I'm Shawna Moore.
And I'm Jaclyn. Dave, you looked like you had something you wanted to say before we get started today.
Well, my mind was wandering. I was thinking about investing. You ever notice how we're all brilliant investors during a bull market?
Yeah, pretty much.
I mean, that sounds dangerous already.
No, seriously. Nobody calls us after the market goes up 20% asking if they're taking too much risk.
Yeah, I mean, that's probably true.
But after a correction, suddenly everybody wants to talk about risk.
Yep. I mean, but that's human nature. You know, when markets are going up, risk feels comfortable. When markets are going down, risk feels very, very real.
It's amazing how our risk tolerance seems to move right along with our account balance.
Well, that might be one of the truest things you have ever said.
Wow.
It's true.
I only speak the truth.
But that's actually what sparked today's conversation. You know, before we started recording, I did, pose a question. If I told you that your portfolio could go up another 10%, but there was also a reasonable chance that it could decline 20 or 30% first, would you take that deal?
Well, and that's a much harder question than it sounds.
My answer was, how old am I? Because at 40, that's one answer. At 65, it's another answer. And at 75, well, that's probably a completely different conversation.
Exactly. So timing, your age makes a big difference. And that's really where we're going today. It's not whether the market is good or whether the market is bad. It's not whether we're predicting a correction. We are not. The question is, what is the next 10% gain supposed to accomplish? Because for many successful investors, that's the question they haven't asked themselves in a very long time.
Yeah, and I have a feeling that we're going to unpack that from several different angles today.
Yep, and probably get ourselves into a little bit of trouble along the way.
For Dave, definitely a little bit of trouble.
Mm-hmm.
Don't we always get into trouble, guys?
Mm-hmm.
I think we do. Technically, we do.
I do.
Dave does. He's in constant trouble, but that's a husband. He loves it. He complains, but he really likes
husbands
being
are used to it. So
Yep. Well, I would say even out of the three of us, even though I'm your child, I'm more well behaved than you.
Right. Well, and you have a fiance. Is he already getting into himself in the doghouse yet or no?
Oh yeah.
Yeah. Well,
Can we go back to how you pronounce that, Shawna?
What word? Fiance?
Yeah. Wait. Say that one more time.
Fiance.
Okay. You originally said fiance.
Oh.
Yeah.
I was just emphasizing for you, Jaclyn. Mm-hmm. Because remember there was that episode where we said something about her significant other and she said she totally forgot about Quinn and we said, yeah, I hope he doesn't listen to this. So, I'm just making sure I'm reminding you.
Yeah, exactly.
Jaclyn, you might be our co-host, but I'm on Quinn's side.
Oh, okay. Well, you know what? Shawna and I are more powerful than the two of you combined. So
we want you to think that. Okay? We have the power to let you think that.
Well, how are you guys doing?
Overall, we're doing very, very good.
Yeah, we're doing well.
Things are busy. Kids are kind of getting their start with college and they're in their college sports and getting going. So, yeah,
so
it's a busy time of year.
And you're never really around, huh?
Getting the routines down.
Yeah.
Is a big thing. So,
Yeah, absolutely. Well, let's get into today's episode.
Let's do it.
Welcome to More Wealth Retirement Talk, where finance meets fun.
Join financial expert Shawna Moore,
sports analogy pro and dad joke king Dave Moore,
and Jaclyn Gladhill, who keeps us all on track
as we break down retirement planning with insights,
laughs,
and a whole lot of more wisdom.
So let's address the obvious question here. I mean, why are we talking about risk and markets and why are we talking about this now? I mean, are you worried about the market?
No, we're not really worried about the market. We're paying attention to the market, and there's a difference between being worried or paying attention.
So what exactly are you paying attention to?
Well, there's a lot of things. Obviously, we've had a tremendous run. AI, artificial intelligence, continues to dominate headlines. There's a relatively small number of companies that have driven a huge percentage of market performance, for example, in the S&P 500. So, investor optimism is high. And in some areas of the market, valuations are becoming elevated. Many investors have seen significant growth in their portfolios. And none of that means that a correction is necessarily coming, but it does mean that this is a good time to ask whether your current level of risk still aligns with your goals.
And one thing I've learned over the years is that people spend a lot of time worrying about the next recession and almost no time worrying about the possibility that they've simply outgrown the level of risk they're taking.
Well, that's really interesting. So what do you mean by outgrow it?
Well, think about it. A portfolio that made perfect sense when you were 45 may not make perfect sense when you're 65. Not because you're older, because your objectives are different. They've changed a little bit.
Yep, and that's huge because most people think risk should be determined by age, but I actually think risk should be determined by purpose, what your purpose is for your assets.
So this is where the, next 10% question comes in.
Exactly. Because, when markets have been strong for a long time, like we've seen recently for many years, people naturally focus on what they might gain. But I think it's equally important to ask, what does that gain actually do for you?
That's such a great question to ask. But what's the biggest question that you're hearing from people right now, Shawna?
Well, honestly, what we hear the most is simply, are we okay? They're not asking, can we beat the market? It's not, hey, what's the hottest stock in general? They're asking, are we okay? And, we sit down with our clients and with couples, regularly in the early 60s, maybe their late 50s. But we sat down with someone in the last week and, they're really great people. They worked hard. They've saved consistently. They've done all the right things. And they asked that exact question, are we okay?
And what struck us was that they weren't asking, how do we make another 10%? They were asking, how do we make sure we don't make a mistake? And that's a very different question.
And that's a great point. And honestly, it's a huge distinction because, building wealth and then protecting wealth are two very different skills. So, Shawna, you said something before the show that really stuck with me. The promises people make after bear markets.
Absolutely. And, I've been in the business a long time. I've heard it my entire career. But for example, if you go back to 2008, after 2008 with the bear market, people said, if I can just get back to even, I'm going to become more conservative. I'm going to protect some gains. Then what happens? It took a while, but the market slowly recovers. Then it just keeps going. And suddenly no one wants to make those changes that they promised they would make to prevent what happened to them in 2008 from repeating itself.
Mm-hmm. I mean, the pain fades.
Exactly. So they kind of forget what that pain felt like. And what's interesting is that, many, they weren't wrong. They maybe should have just adjusted their risk, but they never revisited that conversation.
And that's where I think the next 10% question gets really interesting. Because after a bear market, nobody's focused on the next 10%. They're focused on getting back to even.
Yeah. And what, that tells us something that's super important is that they often don't appreciate what they have until they temporarily lose it.
Well, and great points. So let's go back to the question here. What is the next 10% really supposed to accomplish? Because I think that's, the heart of today's show and our episode.
Absolutely. I think the next 10% question is really a risk capacity question, not a risk tolerance question. So, I'll give you a quick kind of example. Let's say someone's accumulated maybe $1 million or 2 million, 4 million. Notice I didn't say 10 million. So this conversation is not just for, ultra wealthy families, even if you have less than $1 million, but it's for anyone really who has worked hard and built meaningful retirement assets. Now ask yourself, if your portfolio grows another 10%, so if you do have $1 million, it grows to 1.1. If you have 500,000, it goes to 550. What changes? Do you get to retire earlier, travel more, help family, maybe leave a larger legacy? Or does that 10% mostly just change the number on your statement?
And that's not a sarcastic question. We ask that all the time. If the answer is honestly, not much changes, then maybe we should think differently about the amount of risk we're taking.
Absolutely. Because planning isn't about getting every possible dollar you could possibly make in the stock market. It's about aligning your money with your life.
Yes. And one thing I hear people say all the time is, I can handle risk, right?
Right. And that might be true, depending on your situation, you might be able to handle some risk. But I think we sometimes focus on the wrong question. The financial industry talks a lot about risk tolerance. How much volatility can you emotionally handle? But I think an even more important question is, how much risk do you actually need to take? That's risk capacity. As you get near to retirement and you're pretty well set, do you really need to take on that extra risk? So those aren't the same thing between risk tolerance and risk capacity. They're two different things.
Well, so then, Shawna, can you explain the difference? Because I don't understand.
Well, someone can be perfectly comfortable taking on a tremendous amount of risk in their portfolio, but that doesn't necessarily mean they need to. So let's say you've built enough assets to retire comfortably, your income plan is solid, your goals are funded, your family's protected. At that point, the question, it changes. It should change. It's no longer, can I take risk? But the question becomes, why am I taking this level of risk?
And that's huge. Just because you can ride the roller coaster doesn't mean you need to buy another ticket.
Yeah, that's actually a great visual, Dave. I'll give you that one.
Yeah, I appreciate that. Well, hey, and that's where people get stuck. They assume that if they can emotionally handle market volatility, they should continue taking the same amount of risk they've always taken. But those are two completely different decisions.
Exactly. And a lot of, again, successful investors do have a high risk tolerance, but the question is whether they still need high risk exposure to accomplish their goals. And that's more of a planning conversation, not an investing conversation.
Well, let's kind of dive into something that most investors underestimate, losses. So going back to that original question here, if losing 30% requires over 40% just to recover, the next 10% starts looking a little different.
Exactly. And this is actually one of the simplest concepts that we have, but most of our clients, most of the people that come to us haven't looked at that. But for example, if you lose 10%, you need roughly, say, 11, 12% to recover. If you lose 20%, you need 25% to get back to even. Lose 30%, you need 40. And if you lose 50% of your account balance in a market recession, you need 100% to recover. And that's before we even talk about the time frame for that recovery to happen.
And that's the part people forget. Recovering isn't automatic. It takes time.
Exactly. And time becomes more valuable the closer you get to retirement.
Yes. Well, and speaking of time, I like to say that time is money, right? And one thing we haven't talked about yet is the time aspect here. So because losing money is one thing, but recovering from the losses, like you said, it takes time too.
Yeah. And we see that what I believe is that that's the part many investors overlook because most people focus on the percentage. We focus on the years because if someone loses 30 or 40% of their account balance, the question isn't just how much do I need to make back? The question becomes how long might that take?
Huge. Because if you're 35, you may have decades ahead of you. If you're retired, time suddenly becomes a more valuable asset.
Exactly. And one of the illustrations we were reviewing recently with clients showed something interesting. So depending on the rate of return, recovering from a significant loss can take years, sometimes many years. Go back to 2008, it took people about 10 years to fully recover. And that's why retirement planning isn't just about maximizing returns. It's protecting your assets and it's about protecting time.
Yeah. Well, and I've never heard it phrased that way, protecting time. I like that.
Yeah, thank you. Well, think about it. If someone's still working and you're contributing to your retirement accounts, a market decline can actually become an opportunity where you can buy more at lower prices. But once you're retired or you're close to retirement, but if you're retired and taking income from your portfolio, a major decline can create a completely different set of challenges.
And that's where sequence of returns risk starts becoming a real issue, right? Not because the market won't recover, but because your timeline may now be different than the market's timeline.
Right. And that's why I think people need to stop asking, can the market recover? Because historically it usually has. It's probably going to recover. But a better question, I think, is, do I have the time to wait for that recovery?
And one thing we haven't talked about yet is something that seems almost too simple. The value of not losing money.
Right? Two totally different ways of thinking about it. I mean, everybody gets excited about making money. That goes without saying. Nobody gets excited about not losing it.
Yeah.
Oh, that's true. Again, Dave, what's up with this?
Yep. Agreed. 100%. Good one. And I think that's one of the most overlooked concepts when it comes to investing. We spend so much time talking about returns that we rarely talk about the power of avoiding losses, because every time your portfolio goes backwards, you're spending future returns just trying to recover.
And that's what people forget. Recovery has a cost.
Right. And that's why I think many investors underestimate the value of protecting gains. It's not because we're trying to eliminate growth, and it's not because we're trying to predict market corrections, but because there's incredible power in not having to climb out of a hole.
So what you're saying is sometimes the bigger advantage isn't making more.
Yes, exactly. Sometimes the biggest advantage is giving back less, and that's very different.
Which isn't nearly as exciting as making more, but it can be just as powerful, right?
Mm-hmm.
Yes. And you had a great analogy before the show.
I don't know about great, but I think people understand it. I mean, imagine sitting down at a poker table with $100, right? We've pretty much all done that. A few hours later, you have $1,000. Most people don't leave every chip on the table. They put some in their pocket, not because they're scared, but because they're smart.
Right. Mm-hmm. And that's the question investors should ask themselves. Not, should I cash out? It's not, should I stop investing? The question is, should I be intentional about protecting some of what I've already built?
Well, why do you think it's so hard for some people to, take some chips off the table?
Well, it could be they're on a roll. It could be because everybody wants to be the person who got off the roller coaster right before the drop. But nobody wants to be the person who got off right before it went higher.
That's probably true. Again, Dave, I don't know what's up with you today.
I came ready to play.
It is. And we hear that all the time. People it might go a little bit higher. So everyone wants hindsight before hindsight actually exists. And that's why it's not about predicting markets. It's about aligning risk with purpose. And it makes me think of one of our clients that we've had working with us for several years. And her husband had everything, 100% of their assets in Tesla stock. And now we know Tesla stock's done very well, right, over the years, but it's gone way up, but it's also swung way down. So after he passed away, we had to reposition some things, and she agreed to sell some of the Tesla to put into more safe income. But there would come a year later, Tesla kind of had another peak. She said, hey, she called up and said, we're at the top. Let's take some of that risk off the table, take some of that out and put it somewhere safe, and let the rest ride. So that's what we're talking about here. Is it doesn't mean you get completely out, but take some of that off the table, take some of the poker chips back, put it somewhere where hey, now we can get a more moderate return. But don't leave all of it in there, because then when it goes down, now where are you at that point?
There's another way to look at it. And me, I love my time in Vegas, right?
Oh, he does.
Okay, remember, and everybody knows this has been in Vegas a few times. There's a reason why those buildings are as big as they are, look the way they do, are kept up like they are. There's a reason why. I mean, because a lot of people who've won a lot of hands, they keep thinking, well, how much more can I win? Honestly, you need to protect some of your winnings. Put a little bit away. Take a little bit, so then when you do hit that dip, you still come out a winner. But Vegas thrives on the people who are like, oh, I'm on a roll. I'm going to keep being all in, all in, all in. Well, sooner or later, you're going to hit that dip.
Exactly. If today's conversation has you wondering whether your current portfolio still aligns with your retirement goals, that's exactly why we offer complimentary second opinions, not just on investments, but on the entire retirement picture: income planning, taxes, Social Security, healthcare, legacy planning. Will help you determine whether all of those pieces are working together. That's much more wealth.
That's more with two O's.
That's more with two O's.
Yeah.
All right. Well, before we end this episode, let's kind of put this into practice and make it a little practical for our listeners. So, Shawna, what should someone do after listening today? What are the action steps?
Well, there's three things you could do. First, ask yourself and be honest what the next 10% is supposed to accomplish. Really think about that. The second thing to think about, if the market were to drop 20% tomorrow, would that change your retirement plans? And then the third question I would ask, when was the last time someone stress tested your retirement plan? Not your investments, but your plan, because again, those are very different things.
And if your answer is, I don't remember, then that's probably a pretty good sign to get in and talk to someone.
Yes.
Great point, Dave. And I really do like those 3 questions, Shawna, because I think a lot of people listening are realizing that they might not know the answers to those.
And that's okay. In fact, that's exactly why we have these conversations every day. If you're listening and thinking, hey, I'm not sure whether my current portfolio still matches my retirement goals, or maybe you're thinking, I'm not really sure how much risk I need to take anymore. Again, that's exactly why we offer the complimentary consultations and second opinions.
We'll help you evaluate your investments, your income plan, your tax strategy, your Social Security decisions, and how all of those pieces fit together. There's no pressure, no obligations, just a whole lot of clarity. Sometimes the biggest value isn't finding a better investment. It's finding out whether your current plan is actually doing what you want it to do.
Exactly. So feel free, give us a call, 833-4-MY-WEALTH. That's 833-469-9325, or you can visit our website at Moore, that's Moore, wealthtalk.com.
All right. So this is going to be rapid fire here. 1 sentence each. That's your max. What is the takeaway?
I don't know if Shawna and I can handle that. 1 sentence.
Can we do like maybe 2 or 3?
Okay.
All right. Well, hey, building wealth and protecting wealth are 2 totally different skills. It's kind of like climbing a mountain. The skills required to get to the top aren't always the same skills required to get down safely.
Dave,
Yes.
that's 3 sentences.
Yeah, but it's one good point.
Yeah, it was one good point. And the moment that you realize that is often the moment retirement planning becomes much more powerful, because again, the goal is not to squeeze every possible dollar out of the market. The goal is to make sure the money you've worked for your entire life to build can support the life you've worked your entire life to create in retirement.
Yes. Well, and before we go, Shawna, don't forget about Shawna's book.
That's right. If you'd like a complimentary copy of Shawna's book, Retire with More, The Holistic Approach for a Relaxed Retirement, call the office and we'll send one out to you.
And don't forget, if you've enjoyed today's conversation, make sure you subscribe to More Wealth Retirement Talk wherever you listen to podcasts so that you never miss a future episode.
Well, that's all that we have for today's edition of More Wealth Retirement Talk. So listeners, thank you for listening, and we'll see you guys next time.
Take care, y'all.
We'll see you next week. Thanks for tuning in to More Wealth Retirement Talk with Shawna,
Dave,
and Jaclyn.
We hope you enjoyed the mix of financial insight,
sports wisdom,
and a few dad jokes along the way.
Join us next week for more ways to plan smart,
laugh often,
and retire with confidence.
Advisory services are offered through Moore Wealth Partners, LLC, an investment advisory in the state of Tennessee. Insurance products and services are offered through Moore Wealth Management, LLC, an affiliated company.